Good morning, ladies and gentlemen. I wanted to do something slightly different this week, and that is examine all the different cross currents I'm seeing at the moment and what is bothering me about this market. The trend remains weak. We're still in the first quadrant, around the 30 mark. Sometimes we go up to 40, back to 30, up to 40. Basically, this is a weak trend, but it's not a weak trend in price. It's a very strong trend in price, while the spreads are showing a very weak trend. And that is something that we need to examine, and we need to have a look at historical parallels and see where we actually might be in terms of other time frames that we have seen in the past. If we look at the 2-year note as the proxy for the whole of the bond market, we can see that basically we are now stuck. We have discounted everything the Fed is likely to do, i.e. nothing. And we are just range trading between 180 and 140, a 40 basis point range. And we're getting tighter and tighter, which makes sense because people are taking out any thought of further easing in the next 4 weeks, i.e. in December, and we're looking now to the longer term, and the yield curve is steepening and flattening with the news. 2 years pretty much stuck. And really that is all that is to be said about the whole of the bond market. You can go and have a look at the back videos about what I think about the 5s and the 10s. But the 2-year is so indicative of where we are in the bond market. In terms of risk on and risk off, it's not going to come from the bond market, it's going to come from the equity market. The bond market is saying that we are here, and we're here for a very long time, give or take 10 or 20 basis points. Right, given that the bond market is not going to give us any clues, we have to have a look at what happened in various different time frames in the past when the market has made a new high from a previous range, and how it behaved. The first time frame I identified is here in very early 2013. The second one is here in very early 2017. And the third part is here towards the end of 2017. These, as you can see, are parts when time frames when the market actually did very much similar in terms of MACD, just turned positive, and like here, you basically you can go and have a look at these charts yourselves. These are the time frames of very early 2013, very early 2017, and September, October of 2017. This is what it looks like to me, as it were, that we are in those periods. If we then compare the level of volatility, i.e. where volatility was trading, this is the equivalent part in very early 2013, and we can see that it was basically roughly at the same level as we are now, around 12%. The other parts were slightly lower, just below around 11, and then around 10%. So these two parts were definitely lower than we were trading at the moment. This part here in early 2013, which looks the most promising, is actually where we were trading roughly 12% where we are now. So we have one period where we are roughly now, and 2 periods when we were lower or significantly lower, because don't forget 10% is nearly 20% lower, and 9% is nearly 30% lower than we are trading at the moment. Okay, but volatility is not really telling us very much, apart from that we are more likely than not to be in a similar period to 2013. But if we look at the model scores back from that early part of 2013, we'll see that they're much higher, 77 all the way up to 93. And we can see that we had been in risk on for a long time. We'd been in risk on since the beginning of 2012 or early 2012, and we just basically intensified that trend. That is all that happened. we intensify that trend. If we look at very early 2017 and we go up in the in this box here, we get to very early 2017. We are going up. Here we are, 27th of January, 27, the first week. We see we're actually going from 98. We have a score of 98. And here it is in 2017, the equivalent period. We'd been in risk on for quite some time, several months before we got this intensification of trend. And then if we look at the September to October part of 2017, this is September of 2017, we see scores of 83 all the way up to 97. And if we have a look here, you can see how long we'd been in risk on. We'd been in risk on all that time, and then we got the blow off top. What I'm trying to show you here is that the model scores are nowhere near what is required to be in true risk on for a long period. And therefore there is something going on which we don't understand, which I don't understand, and that is that the price action is far too strong compared to the spread action, which is much weaker. And also, we've seen from volatility that volatility is not really confirming it, because we're trading at levels at 12% and more. Basically, last week we traded from 12% to 13.5%. Far too high for the realized volatility of the market. So something is going on that if we triangulate all the data points we have, they just don't match up. So back to the weekly chart. And you can see in these periods that we are talking about that we were much closer to this red moving average than we are at the moment. What is that telling me? That is telling me that any pullbacks are actually not going to be anything but healthy, and also that the score of the model is not going to go down very much, if at all, on the pullbacks. The model score, I have looked at all the components again to avoid all the tedium of showing them to you. But basically, the market can pull back 2 to 3% and have absolutely no effect on the model score. Just as a 2 to 3% movement, either in time or in price back down, and if we enlarge this last period, is going to have absolutely make no difference to the trend. We could easily pull back to something like here, i.e. 30.25, and it's going to have no effect on what this looks like. This still looks like a very strong uptrend, even back down to 30.25. It just 2 to 3 weeks of consolidation this way, like basically a bull flag, and then we go again, allows time for these moving averages to catch up. So that is the real danger, and that is what volatility probably is saying, that the market is afraid of that move. If we now have a look at a monthly chart, you will see how close we are to these Bollinger Bands. And every time we've spiked those Bollinger Bands and gone above them, we have retraced. Like here, all these months here, we always retrace those moves and go back to the blue line, and then that is a healthy trend when we keep on bouncing off the blue line. Where does the blue line come in? 3003. Okay, by next month it'll be 3030 or so. So that is what I'm looking at. I'm basically saying that I will not go extremely long at these levels. In fact, at these levels it probably pays to buy 3120 calls and get out of the outrights. So that is the way I'm going to position my my investment account. And as far as trading accounts, I think it is probably a very bad idea to be leveraged long at these levels. 30.30 to 30.60 is where it's going to be wise to ship some more in, but at these levels it's extremely dangerous. The European market, the Japanese market, EEM are all saying the same thing, i.e. they actually had a bit of a negative week last week, not much, but a bit of a negative week, because they were over the Bollinger Bands and they've come down, but they haven't come down a lot. If we enlarge this to have a look, we can see the behavior. They are just going up and down, they're just bouncing off the Bollinger Bands. This is healthy behavior, even if he comes back down to somewhere around here, 12,850. No problem whatsoever. This is still positive. So in conclusion, when we triangulate things, we can see that more time is necessary, if nothing else, to get the spread scores up. We are right hard up against the Bollinger Bands in the monthlies and the weeklies. We are exhausting ourselves. Volatility is not confirming, and that is what's really been bothering me for the past couple of weeks. Why is volatility so elevated? It should be trading down in the tens. And when it's not, that's telling you something. So really, I think that it will pay to be patient here. I know that everybody's bulled up because of the seasonality, but I think some nasty surprise could be lurking around the corner, and I'd much rather be long of calls rather than long of outrights. I know the little I'm going to lose if I'm wrong, and really switching to calls is a far better idea. This is Japan, which looks very much like DAX, but I prefer Japan simply because nobody has any. And if we have a look, exactly the same thing happened to Japan last week. It had a bit of a negative week simply because it had gone straight through the Bollinger Bands. Now, if Japan were to come back to the 0.382 retracement of this, which is around 22,200, would anybody really say that anything had changed, or even just the 23.6, 22,760, which looks a really good level to me? No, I mean, nothing's happened, right? Nothing at all would have happened. So to me, a couple of weeks or even longer of trading in this range, letting the Bollinger Bands go up, is far more likely than a continuation of this very strong market. In summary, what have we seen? We've seen the bonds are now stuck. So risk on, risk off is not going to happen through bonds. It's going to happen through equities. We are now here stuck in a plus or minus 10 basis point outright move up and down, and or curve moves. So the 2s10s will steeple and they will flatten depending on the news. The 2-year will go a maximum up and down 10 basis points, and that's that. We've also seen that the model scores are not emulating previous periods of a similar price action, i.e. very strong price action. Volatility is not confirming it. Only 1 out of the 3 periods is anywhere comparable to what we are having at the moment. The related markets of EU, Japan and EEM are not confirming this strong move. They led and now they're tired. So where they lead, it is reasonable to assume that SPX can follow. We've seen that SPX is hard up against the monthly and the weekly Bollinger Bands, and therefore the risk-reward shifts. My conclusion is that people are being forced into buying equities at bad levels through a combination of factors. Call it seasonality, FOMO, they're worried about their bonus, they're underinvested, whatever. It really doesn't matter. But they're getting in at very bad levels, which is what the market does. It forces you to buy when you least want to buy, and it forces you to sell when you least really want to sell. So my conclusion is simple. You have to switch back to optionality. I think the odds of a move down to the 30-25, 30-50, 30-60, whatever it is area is far higher than people think. And it is just not worth not being long of calls rather than outright at these levels. It's always paid in the past. I'm quite sure that it'll pay in the future, and I'm sure that your investment account will thank you for it, whatever the outcome of this move will be. Thank you very much indeed, and speak to you on Monday.